Hey guys, welcome back. In this video, we are talking about how shorts can't deliver the ultimate catalyst, why we will win, and many more in this video. Now, firstly, we're starting off with this. So ending last week and going to this week as well, what we are going to see is still going to be extreme off-exchange volume. And again, every time we see extreme off-exchange volume, for a stock that's 184, for a stock that poses supposedly no threat, we know that is exactly the opposite. We know that it's because we are pushing the shorts to a position where they can't afford to. One of the best examples, and we've seen this recently, has been when we saw more lit exchange than dark pool on AMC, and we saw AMC go up 14%. Once again, this really clarifies exactly everything that we have been talking about. And we've said that for a long time, had there not been dark pool for the last 5 years, AMC would easily have surpassed the targets that we were expecting for a long time. But when we do see this off exchange, it still means that the shorts are trapped. And so that's the one way we can look at. A big reason for why it also matters is because of the failures to deliver. And talking about how these guys can't deliver anymore on these positions. Now, we've seen FTDs on AMC for plenty of times, but what we are seeing again is the spike up in FTDs. And this is during the time where AMC is going up. This is during the time where AMC is getting manipulated. And it's exactly everything that we have talked about. People claim that AMC is going to go bankrupt. People claim that shorts are no longer trapped in AMC and that they have fully covered, but yet we are seeing the FTDs. When you take a look at everything that's ongoing, when you take a look at institutional accumulation, when you take a look at retail accumulation, you will see that the net inflow has been way bigger than the outflow for a very, very long time. And despite the fact we are seeing the price drop, what people are trying to claim is because people are selling, it clearly doesn't match up with the spike in FTDs. These are just some of the reasons that we understand that even with the offering, even with the shares that are being given out, if they were truly all being given to shorts and absorbed by short sellers to try and get them out of the synthetic positions, it still isn't enough to cover the billions of dollars of positions that they have created, the billions of AMC shares that they have created. And so it's why we know from these data that extremely shorts are trapped in these plays, and why AMC can be looked at an extremely volatile price. So the reason why they can't deliver, we know, is because there's no real shares, or what we are seeing for the IOUs. And you can see here where the FTDs hits the highest level since June of 2024. And these are just what we've said with how if people are worried about the dilution, which again, I've talked about this, how dilution is not the best thing ever. It is something that we don't want to see in the sense that it dilutes and it puts more shares into the market, it increases the flow. But the reason people are worried about it isn't just pure dilution, isn't the fact that it's increasing the float, but rather they're worried about how these shares can be given to shorts to get them out of the position they're in. But if they have gone out of the positions, if they're no longer shorting FTDs, if there is no short sellers, we wouldn't be seeing the FTD data like we are seeing now. Another big example of this is that when you take a look at AMC, what we are seeing right now, 1 billion shares were traded last month on AMC. If you took that as an average baseline this past 67 months, it's 67 billion shares, 110 times the public float of AMC. Now, when it comes to AMC, obviously there is volatility in the sense that we suffer frequently from high frequency trading algorithms. This is something we talked about in the past before. So for AMC to see a higher volume than some other stocks with similar flow is normal. However, what we have to realize is that at the end of the day, the majority of retail are only buying into shares. They're not constantly trading shares. They're not constantly selling shares. The only thing they're doing is constantly buying shares. When we take a look at some of the filings as well for the institutions, they are of course doing the same thing, constantly buying shares, but not constantly selling shares. So whilst you can argue that it's normal to see a high volume for AMC because of the high frequency trading algorithms, which we are seeing, it doesn't make sense to why we're seeing this much. And so whilst the 110 times public flow being traded may not all be synthetic shares that have been created and injected into the system, it definitely already is a very high amount of shares that we are seeing. And so when you even take a look at it, even if it's 10 times the flow, even if it's 6.7 billion shares being traded and being created and flown into the float for the last 67 months, we have to realize the offering that we have been doing still isn't enough to cover that. So they are still trapped with over 6 billion shares that they have created. And this is a very, at least in my opinion, conservative take of how many float has been traded and created into the market. But it goes to show you why the dilution that people are worried about in terms of allowing shorts to get out isn't too much of a problem for me. And as for the apes, as for the fights that we are giving and fighting back against the short sellers, you can see, thank you, John Hampton. You counting on AMC investors like me gave me the courage to buy more. And this is what we said with how apes are constantly buying and not selling, and why we talked about how short sellers are worried because they have done the complete opposite, where they try to create this incentive for apes to sell, but rather we have done the exact opposite. And it's why you see the constant hate on AMC from the short sellers. And if you take a look at another example where we talk about how it's in terms of how many shares people own. And again, this is just from one user who talks about he owns over 20,000 shares. Now, this is one of many apes that we have covered that owns 5-figure digit shares, and it really goes to talk about how easily we have already owned the flow. And then you take into consideration the institution accumulations. We talk about float being sold 10 times over, 50 times over, 100 times over. It is very, very likely. Also, talking about the ultimate catalyst and why so many floats being created is bad for the short sellers and why they still feel the need to manipulate is because they've realized there's so many things that AMC can do which actually could have an effect on them. And one of the things we've seen recently is SEC talking about tokenization. Now, they have actually delayed it, and it feels like there's a reason for why they're trying to delay this, because what we see is that if AMC were to announce or require it to tokenize its complete shares, all existing claims must map to new on-chain tokens. And the blockchain issues exactly the authorized number of tokens, no more, no less. And so any extra synthetic or naked short positions cannot exist anymore. And this is something that we are seeing, and it perhaps is the reason for why SEC is delaying it, because they've realized that easily this could make so many short sellers go bankrupt, because they will see how many tokenized shares of AMC there is. You're going to the market expecting 500, 600 million shares of AMC. But when you tokenize it and you take a look at the system, you start to see not only the complete float, but another additional 10, 20, 30 billion tokens that exist out there. You obviously know you messed up. Now, there is a double-edged sword on this, and it's why it's not all just kind of the final thing to do for AMC. The reason why it's a double-edged sword is because we've seen with the tokenize of shares is that actually it allows the ability for market makers to create tokens of existing shares without the need and consent of the institutions itself, meaning market makers are able to create tokenized shares of AMC without needing AMC to allow them to do so. And so that is the double-edged sword where it could actually create even more. But out of the existing shares that exist out there, we can see how it will be caught when AMC requires for every share to be tokenized. And so what we're also seeing, remember, with this is that 600 million shares being issued in the market over the course of 5 years is nothing compared to the billions of shares traded. And so this is why we've said that I'm not worried about dilution. And when we talk about in terms of going back into why tokenizing the shares, especially if it's under the requirements of AMC, we can see how this is very important because there's transparency, because it's the catalyst, and what we can see is how it can actually force them to cover. Because if they don't want to expose themselves to have created the billions of synthetics, they will need to try and wait to find to cover these shares before AMC tokenizes all of its shares into tokens. And so this is something that could force the covering of short positions. When you take a look at the fundamentals, it's also very good. We just talked about how AMC can beat them. And the biggest thing then for AMC to beat them is for them to not go into bankruptcy. And that's exactly what AMC is doing, avoiding bankruptcy. We've seen how we've cleared a lot of hurdles where we talk about the repayment of all debt. We talk about in terms of the extra money that it will save, the extra money that we are then able to invest and further pay off debt. These are all very good things. As far as Q2 and going into Q3, we already are looking at even better numbers, and we are expecting a higher number with a more efficient AMC to then increase their revenue and profit. What we can also see is that the reason why I talk about how AMC making more money is extremely important is because AMC was able to issue dividends back in 2017 to 18. So if we were able to get into a similar position, we're going to be seeing them issue dividends again. And one of the biggest obstructions to why AMC is not issuing dividends has been because of the liens, has been because of the debt. And so to see them pay this off pushes us one step closer towards dividends, and that's why it's important. Also, we talked about how, again, the reason why we're going to win, the reason why we are strong is because we've seen how AMC has talked about in terms of not going to bankruptcy. We talked about how Adam Aaron is very strong on taking AMC to the next level, talking about the fundamentals. And so all of these things really is talking about end goal. And so we're going to be continuously seeing bearish articles, negative articles. But just like what we saw about how they looked at us in Q1, how they looked at us last year, we're looking at AMC to do the complete opposite of that. And this is only going to continue and get even bigger. And so for me, I'm expecting a very, very large Q2 and a Q3 box office with a very large Q2 result in terms of revenue and profit. We're already seeing how Q3 has a very good shot at 3 billion and it could do even higher than that. Furthermore, you can see again landed at the 5th biggest Q2 of all time and the biggest in 7 years. Whilst food and beverage spending is like 60+% higher per person than 2019, and merchandise sales and ads are far higher. So if you need another reason, if you need another point of data to talk about why I believe the Q2 is going to do so well for AMC when we get the earnings report, is because of reasons like this. It's because we're becoming a much efficient company, whilst the box office has not only not declined, but actually gotten even bigger. And so it's why we've said with the offering, we are positioning ourselves at a very good position. It's not just to pay off the debt. It's not just to for survival, and I definitely think the survival talk has been gone for a long time. I think paying off debt is very different than surviving for AMC, because paying off debt now has been the reasoning of getting closer to paying out dividends, has been reducing interest payments so we can put money elsewhere. And more importantly, to put ourselves in a position, whether it's with M&A, whether it's to do with other infrastructure investments that they want to make, these are the reasoning for why we see the offerings. And it's why we're looking at AMC to become a bigger company than ever. And so it doesn't matter where they bring AMC, if it's down to 0.5 or up to 50, because at the end of the day, AMC is not going bankrupt, AMC is staying here. And what we will see is that once AMC has fully achieved the goal it sets out to be, when we see the true value reflect and people can't ignore it anymore because of the box office growth, because of the efficiency, the infrastructure growth of AMC, because of dividends, when you see everything together, we will naturally see AMC go up. We will naturally see AMC in the hundreds. And just like we've seen this, we've seen apes who have bought into this. We see apes who exactly knows what's going on and why they stand firm and strong going against them. As far as the technicals for AMC, we're looking at very good things again. Once again, still very bullish. We are seeing AMC to really set up to go to 72, to go to 625. These are the levels that we are looking at. As far as the chart goes, again, technicals strong. You see the manipulation, so you understand exactly that's going on. On the other hand, what you have to take a look at is for the Mag 7, who have been recently experiencing massive reds. What we are looking at them is how they are losing money, is how they're struggling. And so as we see the collateral fail, you're really going to be looking at AMC having that massive movement up. As for GME, we're in the same position as well, doing very well fundamentally, looking at major news to be dropped. So there's not much to be worried about. And then macro-wise, when you take a look at the Japanese yen, we are very close to seeing that Japanese yen carry trade, triggering the margin calls that we have been talking about for a very long time. And so this is something that you should also keep your eye on. Now, in terms of how hedge funds are doing, you can see Citadel claims that they are talking broad first half gains. But what we have to talk about is how the fact that they needed to borrow more money despite making, these earnings. And so something clearly doesn't make sense there. And it feels like they're trying to give a good image to raise even more money, but the truth behind that is somewhere that we need to realize is not actually there. As always, learn to have financial advice, and I'll catch you guys next time.